Let's work through a few journal entries for notes payable. So we're told that we need to prepare the journal entries for Russell Company. So on January 1st, they borrowed some money from Foster Company by signing a 120-day 7% note. On April 1st, they borrowed $120,000 from Perry Company, signing an 11-month 9% note. They pay back Foster Company on May 1st. On December 31st, we need to record the interest on the Perry Company note. And then on March 1st, we need to record that we are paying the principal and the interest to Perry Company. So first, on January 1st of 2019, borrowing $75,000 from Foster Company by signing a 120-day 7% note. So what does that mean? Well, that means that we are getting money. We're getting $75,000. And we're saying that we're going to pay back Foster Company in 120 days with 7% interest. Here on January 1st, how do we record this? Well, we are getting cash. So we want to debit our cash. And we want to credit notes payable because we owe this money in the future. And for how much? $75,000. So here on January 1st, the 120 days and the 7%, that doesn't matter. That's going to come into play later on when we start dealing with interest and when we have to pay back Foster Company. Now on April 1st, we borrowed $120,000 from Perry Company by signing an 11-month 9% note. So the numbers changed here, but the idea stayed the same, right? We got cash on a note. So we debit cash and we credit our notes payable. And for how much? The face value of that note, the $120,000. Now May 1st rolls around. It's been 120 days since we initially borrowed money from Foster Company, so we have to pay them back. So how do we record paying principal and interest to Foster Company? Well, we're going to debit notes payable because we want to get that notes payable off of our books. What other accounts are we going to be dealing with here? Well, we're going to have to deal with an interest expense. There was that 7% interest on that note. So we're going to need to calculate the interest and then include that in our payment. And then we credit cash because we are paying Foster Company this money. So now how about the numbers? Well, notes payable, that's just the amount, the face value of that note, right? The $75,000. Interest expense, we'll calculate our interest expense by taking our principal times our rate times time. So our principal, $75,000, interest rate 7% or 0.07, and time, you'll notice it's 120 over 360. So whenever you're given time in terms of days, like we are here, we take our number of days out of 360. Then our interest will be $1,750. So we'll plug that into our journal entry. So our cash is our principal and our interest. So we add the $75,000 and the $1,750 together, and we credit cash for $76,750. So now on December 31st, we need to record the interest on the Perry Company note. So the Perry Company note, that's our note from April 1st. So what accounts are we going to be dealing with here? Well, we need to debit our interest expense and credit interest payable because we aren't paying the interest yet. That will come later on March 1st. Here we just want to record this expense. Now, how do we know the number? Well, we need to calculate it again. So we go principal times rate times time. Our principal is $120,000. Our rate was 9% or 0.09, times 9 over 12. And how did we get 9 over 12? Well, we count the number of months from when we first borrowed the money to the end of December, and that's 9 months. And why do we divide that by 12? Because our interest rate, our 9%, is an annual interest rate. So if we multiply that out, we get an interest amount of $8,100. So we'll plug that into our journal entry. Now March 1st, our final journal entry here, we need to pay the principal and the interest to Perry Company. So this is going to be a little bit similar to what we did a few journal entries ago. So we're going to debit our notes payable because we want to get that notes payable off of our books. We need to debit interest payable because we want to get that off of the books. We also need to debit interest expense. Then credit cash. So notes payable, that's just the principal of the note. Interest payable, that's the amount that we found, the $8,100. Interest expense is for the month of January and February because we have not recorded this interest yet. So we need to calculate it again. So we take our principal times our interest rate times 2 over 12 because we only need to worry about January and February. And our interest comes out to be $1,800. So we'll plug that in for our interest expense. Now our cash, that's our principal plus our interest. So we take $120,000 plus $8,100 plus $1,800, and we credit cash for $129,900.